This is Report to Wyoming.
During the October 7th Natrona County Board of Commissioners meeting, Joan Evans of PFM Asset Management and Troy Hunsucker of Peaks Investment Management presented the financial overview covering the county's managed funds for the second quarter of this year. So far, the county's portfolio has seen strong gains, but the advisors warned of a slowing labor market amidst ongoing national fiscal uncertainty. And I'm going to play a recording from that meeting now.
Troy and I have, what we try to do is alternate each time we meet with you on giving a market update. And so we're going to kind of tag team that today. I believe Troy's giving you a Q2 report. I'm giving you a report on your second quarter investments, which actually ended June of 2025. So we're a little bit late. We're starting into the fourth quarter now. So the market data is a bit dated. So we're going to kind of update that for you, and then we'll each individually give you on the investments that we have under management. So we'll use the market update that's included in the PFMAM presentation. And so I'll kind of run through that, and then if Troy has anything to add, we can just kind of take some questions and go from there. So keep in mind the information in your packet is for the quarter end June 30. In Q2, the theme was really uncertainty in the market, as you can recall. If we look at current market themes to date, however, the labor market is continuing to show signs of weakening, averaging just about 29,000 jobs added on average over the summer. So low hiring, a lot of that in regard to aging out in the workforce, potential immigration policy, tightening, fiscal tightening, really not seeing the full effects of tariffs yet. So tightening, really adding pressure to the labor market. At the end of June, the Fed remained on hold for cutting rates. They've been on hold since 2024. In July, they held steady, with two of the Fed governors dissenting on that decision. But now that we've seen them take action, we did see a cut in September to change the overnight rate to between 4 and 4.25%, citing rising risks in the labor market. And we'll talk a little bit about the dual mandate for the Fed here in just a moment. Treasury yields in quarter two, we saw them whipsawing a bit with concerns over the budget bill, the debt ceiling, monetary policy. Rates have been trending lower this week with the shutdown and talks of federal layoffs. We'll talk more about that here in just a minute. On the next page of your report, this would be page 5. You can see what was causing some of the uncertainty in the second quarter and really still remains today. So impacts of tariffs have only really started to feed into the consumer prices, and the jobs market is no longer providing that cushion that it had been providing earlier. So you can see this tracking of the effective tariff rate and back from February through July, and the fiscal policy that's kind of adding to the uncertainty in regard to budget, tax reform, funding freezes, debt ceiling, those types of issues. The next page, just to give you kind of some insight into the impacts of the reconciliation bill, you can see over on the left-hand side, Congressional Budget Office estimates on implications of the bill that are adding to the deficit or reducing the deficit, but the total deficit impact of the bill was a deficit of $3.3 trillion. Now, monthly tariff revenue, just to note though, in July of 2024, tariff revenue was bringing in about $7 billion a month, and in July of 2025, that number was $28 billion. So you can see where the tariff revenue is starting to kind of build up toward that, but the overall deficit of the bill still remains at $3.3 trillion. Next page, this really, the Moody's downgrade on May 16th, 2025 really ties into that whole conversation about the deficit. This was not an unexpected downgrade. Large fiscal deficits have led to an increase in government debt and interest payment ratios So Moody's followed suit with the other two major rating agencies, S&P and Fitch, who had previously downgraded the federal government in 2011 and 2023, respectively. So was not unexpected and did not really have a huge impact on the market at that time. The next page, on page 8, you can kind of see a heat map through Q2 of economic momentum that have really kind of slowed down amid the uncertainty. I just will note there in that third column down, the real GDP quarter over quarter, you can see that at the beginning of 2025 in the first quarter, we did see a negative GDP reading. It did bounce back in second quarter. Two consecutive quarters of a negative GDP reading can indicate the possibility of an onset of a recession. So we didn't see that follow suit in the second quarter, but just something to kind of keep an eye on. I mentioned earlier the Fed's dual mandate, so they are charged with keeping stable prices and maximum employment. Stable prices being measured by inflation. The target rate is 2% for inflation, and maximum employment is really just the most people that can be employed at any given time and still keeping inflation in check. I mentioned the Fed had been on hold since 2024, but in light of rising risks with the unemployment rate, slowing growth in jobs, this led to a cut in September. So if you look over on the left, the core PCE inflation, this is the Fed's preferred measure of inflation. In comparison to the CPI, the Consumer Price Index, that's more of a basket of goods that's paid for by consumers. The PCE, the Personal Consumption Index, measures not only things that we buy, but things that are paid for on our behalf, like insurance benefits, education, those types of things. So you can see that has been ticking up slightly, and in August of 279, in August of 2025, it was 2.9%. And core strips out two of the volatile components of inflation, food and energy. And if you hear the word supercore, that's also stripping out housing. Over on the right-hand side, unemployment rate, you can see that it has also in June, we were looking at a 4.1, July 4.2, August 4.3, so kind of ticking up. And the labor force participation rate has also been declining, which can signal a slowdown in the economy, aging out in the workforce, those types of things.
Jill, I got a quick question for you.
Sure.
And I this is something that I've known for a while, but why do they take out some of the most volatile items, i.e. food and fuel, out of the CEP? Because that's our CPI, because that's something that affects everybody directly faster than anything else. And I never have, I'm just asking for your opinion. I know that's not something that you make that decision. I know neither one of you
Troy,
get to make that decision, but I'm just curious if you can kind of enlighten us a little bit on why they justify doing that.
Right. I think mostly because it kind of strips out, so to speak, the noise and really gets down to that basket of goods. And those prices are changing very frequently. And also housing is a lagging, the data on housing is very lagging. So if you take that out, you can get much more of a real-time estimate of what the actual inflation number is. I don't know, Troy, do you have anything to add to that?
Yeah, I'll be maybe a little more candid. I appreciate Joan's.
It's just us, so.
Joan's taking the high road. They did used to include it. It was done during the Obama administration, and I'm not trying to single out that administration specifically. I do think some of it was political to make the numbers a little softer, but as we all know and Joan's discussed, the food and energy is really volatile, so it is a more difficult calculation. So I think it was a partial component of being a political play, but then to try to soften the numbers so they seem a little less volatile when they're presented, right, which dovetails into the political presentation of it.
Okay. Well, that was kind of what my thoughts were along that line, is so it didn't look as bad.
Right, and it obviously, much of what we felt during the inflation of the last few years is food and energy that is a big
Right.
component, which is not included in that calculation. So we feel the pain, but we don't necessarily see it in the numbers that are presented.
Right. Okay. All right. Sorry.
No,
Didn't mean to
that's a great
interrupt.
question. That's a great question. Moving on to page 10, this is a updated summary of economic projections that comes out quarterly after the Fed meets. And so really the light bars there are showing the previous quarter projections of where we thought GDP, unemployment, inflation would be, Fed funds rate, and then in June, where the projections have moved to. So you can kind of see where we thought that GDP would be going down. It has actually ticked upwards. We saw unemployment a little bit lower than that 4.5, inflation very close to 3% that was projected for June, and the Fed funds rate was the same at that time. The next page shows the Fed's latest dot plot, which isn't the latest because this is June's, but we do know that in September, the dot plot that came out was still a divided camp. So you have some of the voting governors that are saying 0 cuts. You have another significant portion saying 2 cuts. But there was one dissension at the September meeting, and that would be by Governor Meehan, when the newer governors was calling for actually, what would that have been, 5 cuts, so 125 basis points, so 5 cuts. So really kind of showing that, putting that stake in the ground, saying that rates need to be lower than they are. So we'll get a revised dot plot out shortly. Next page, this just really indicates the Treasury volatility that can really happen when things are happening in the world and in the economy. So if you go back to April, thinking about reciprocal tariffs, Liberation Day, so to speak, you can see the volatility in the Treasury market, intraday trading and where it closed off. In May, we saw a strong payrolls report. You can see the reaction there, the Moody's downgrade, not really much. Global conflicts can really create a lot of trading volatility, especially with the 2-year Treasury. And yields today closed very close to where they were at the end of the quarter, with the exception, of course, of the overnight rate, which is lower. On the next page, this shows really the range of the Treasury yield curve over the past year. And so the shaded area shows the 1-year range. The dark blue line is the end of June and where we were the previous quarter. I will note that as today, if you look at the 2-year Treasury yield at the end of June was 3.72 and today is 3.66. So 10-year is 4.17, just slightly under where we were in June, and the 30-year at 4.75. So investors' expectations of still higher inflation and higher borrowing costs, they're expecting those to remain elevated for a period of time. On page 14, you can look at the spreads. Narrowing has helped performance. This is really looking at different sectors that we consider for your portfolio and where they were in regard to U.S. Treasuries. And so you see there in that February, March, April time frame, we did see spreads widen out in regard to U.S. Treasuries, which created some opportunity in those sectors. As the spreads narrow in, I mean, when the spreads are tight, you're still getting absolute yield from your older holdings, which still beat sometimes the new issue prices. So one thing that I will talk a minute when I go over specifically the performance in your portfolio, we'll talk more about corporates and your decision to add corporates into your investment policy. I'll go ahead and skip pretty quickly over slide 15 and 16, but 15 shows really 1 year out on the sector yield spreads for federal agencies, corporate notes, mortgage-backed securities, and agency-backed securities. And page 16 really just kind of narrows that in for the quarter. So you can see up there on the upper right-hand side where we talk about corporate notes, that widening there that you see, the bump up in the yellow line, it provides a good opportunity to add those securities to an investment portfolio. The fixed income index excess returns on page 17. You can see, again, the different types of securities that are available to you and kind of where we were seeing value over the quarter and year to date and 1 year. You can see that federal agencies really aren't adding much value at the time, really growing concerns, investor concerns around, federal regulations and things like that. On page 18, the fixed income index total returns for Q2. Again, if you look over to the gray bar, you can see the U.S. Treasury and the other 4 types of securities as compared to the Treasury. Factors to look at over the next 6 to 12 months. We're really, because of the uncertainty, just kind of in a holding neutral pattern. I mean, not really one way or another on anything, except I would say that labor markets are starting to move more toward the slightly negative, the cooling off, the modest job gains that we've seen over the summer. The fixed income commentary just gives you a little bit more specific information about each type of security that was considered for your portfolio. And looking into 3Q, which we've just now wrapped up, you can see if you move your eyes about 2/3 of the way down the page, on page 22 to corporates, you'll see, again, we've seen the multi-year lows in the corporate spreads. So that's why you're seeing the slightly negative there to kind of the neutral aspect of that adding value. So I'll wrap up there on the market update. Troy, anything that you'd like to jump in here and add?
Yeah, sure. I'd like to just add a couple things to Joan's commentary here. She did mention that we're kind of going forward, we're going to be kind of in a flat space. As far as yields are concerned, the Fed meets again here at the end of the month. The markets are expecting about a 91% probability that they will do another rate cut. So we would anticipate another 25 basis points reduction. However, looking out over the long term into even the end of 2027, beginning of 2028, the markets look like the 5-year Treasury is going to be about where it is now. So though we're expecting a cut, it kind of is congruent with what Joan was saying. We're kind of in this space where we expect yields. This is kind of where we're going to be going forward. She mentioned unemployment. It is worth noting that unemployment usually comes out on the first Friday of the month. Due to the government shutdown, the unemployment for September was not released. Indications this week have said that the numbers would not have looked very good. So we don't know how dismal they would have been, but we're still kind of in the space of not knowing where we're going to be going forward. So I will just, those are a couple. Wyoming unemployment also is 2.7%. So in terms of, 4.2, 4.3% on the national level, Wyoming's in a really good space right now. So I want to add that in there. But I think Joan covered most all of it. Just want to add those couple bullet points.
And I will say too, we talked a lot about the dual mandate, that the Fed, is data dependent to make their decisions on whether to leave the overnight rate, increase it, or decrease it. So really, they are really flying blind right now because there won't be any BLS data that will be released more than likely before they meet on the 28th and 29th of October. Even if the government were to reopen like next week, those releases would take time to be put together. So they're going to be flying a little bit blind. There are some private payroll numbers that do come out that they can look at. Those are not as heavily relied upon as the BLS data. So a little bit of an uncertain time with the shutdown. And, typically in times of a government shutdown, it starts to impact the GDP. So 0.1, 0.2% per day typically, which is usually recouped once those federal workers go back to work and get their pay back. I think the uncertain part of it now is that will there be layoffs? Will all of them actually go back to work? And will they actually recoup all of the pay that they didn't get during the shutdown period? So some kind of unknowns as this shutdown kind of looms and moves into a longer period of time. Right. So now we can go into our individual reports. Troy, you want to go first? Okay,
Yeah.
great. Flip a coin or something like that. All right, well, I'll move into your, so this will be on page 23 of the same packet that we were just looking at. Again, I did fail to introduce myself earlier. I believe I know all of you, but Joan Evans. I'm a director with PFM Asset Management from Cheyenne, and it's a pleasure to be here today to go over your portfolio results for the second quarter of 2025. If you look on page 24, this is a summary of the funds that we have under management for you. In a managed portfolio, we typically kind of categorize these as the hospital funds. So funds that you invested with PFM Asset Management post sale of that property. In addition to the total market value of the portfolio, you also have just over $6 million in a liquid fund with the Wyoming Government Investment Fund that is also managed by PFM Asset Management. So total altogether, just over $51 million there. And that $6 million is earning interest really tied to the overnight Fed funds rate. If you look over at the right-hand side, or here under the left-hand top section, you'll see the market value of your portfolio and the effective duration and the benchmark duration. So as I mentioned earlier, with spreads being so tight, we're really sticking very close to duration right now to give ourselves the opportunity to take advantage of a sector that starts to show value for your portfolio. So really, where we are right on top of the benchmark right now, we are benchmarking this portfolio against the 0 to 5 year Treasury index. And so your yield at market would be the yield that you bought the securities, and your yield at cost would be as if we went out and bought everything for you today. You can see the credit quality of your portfolio is AA. According to state statute, that has to be at least an A minus. Over on the right-hand side, you'll see your sector allocation. And what I want to draw your attention to here is the kind of gold shaded bar that says corporate. So as you recall, you changed your investment policy last spring to be able to include corporate notes, which are eligible by Wyoming state statute to be added into your portfolio. You set your maximum allocation for the portfolio at that time at 20%. And so right at the end of Q2, you had 10%, and keep in mind that spreads were pretty narrow. The policy wasn't changed until May, so you missed out on some of that spread widening that was seen around Liberation Day, but there was also some opportunity more toward the end of Q2. But with spreads being close to multi-year lows, we're just really selectively adding corporates right now. I think we're up to about 13% now in Q3. I would say that it would always be a good idea to, as you get a comfort level with having corporate notes into your portfolio, to consider bumping up that allocation to 25, maybe 30%, to give, more latitude to the portfolio managers to really add something that's going to create more value for you. When those allocations are very small, sometimes it limits the issuers that we can add to your portfolio at that time. Over in the lower left, you can see the credit quality of the securities in your portfolio. And again, I mentioned the duration distribution over on the bottom right-hand side. So as you can see, just really right on top of that benchmark duration. On page 25, you'll see the issuer diversification. We've got quite a bit at the end of Q2 in U.S. Treasuries. That's what our portfolio managers always refer to as the dry powder. So that makes it possible for them to buy something where they see value if they're able to trade in those treasuries and purchase a corporate note or some other security where they see value. So you can kind of see the allocation there, and you can see all of the corporate notes that you hold under the corporate section. This just on page 26, it further breaks out the sector allocation review. It compares back 1 year, so September 2024 through June of 2025. You can see kind of the movement and the ebb and flow of the securities within your portfolio and the decisions that have been made, bringing it all around full circle to 100%. And you can see there in June where that corporate note, the gold bar, was actually introduced for the first time. On the next page, 27, just another way to show your activities. Again, bringing in the corporate notes into your portfolio, and then the trade activity in treasuries. We continue to see value. Even though we did not have a lot of agency CMBS purchases, we hold a lot of that, the commercial mortgage-backed securities in your portfolio, and so they have been able to add value and attributed to the performance that you've seen in the second quarter. Page 28, again, just a depiction of your net activity and putting some dollar signs behind that. So on page 29, you can see your portfolio performance. You can see your interest earned, your change in market value for the last quarter, for the last year, and since inception on the portfolio. The portfolio earned 1.42% during the second quarter of 2025, and the benchmark was 1.28, so exceeded the benchmark by 14 basis points. You can see over on the right-hand side, since inception, 27 basis points over the benchmark. Page 31, you can see the accrual-based earnings. So this, starts you out in April of 2024 when we first started the portfolio to today. These are, actual earnings that you've had on your funds. You can really look at that as, I believe, a success for all of you, having a vision, developing a strategy, working with investment advisors to professionally manage these funds to not only keep your funds safe as government funds, but help you seek out the best return possible and still keep your investment core safe. You can see your issuer distribution on page 32. Again, heavily concentrated into treasuries and then into your corporate notes as well. So that wraps up the report. I'd be happy to take any questions that you may have.
How much money have we made having invested with your firm from start to today?
Chairman North, Commissioner Laird, if you want to look on page, let's see, where are we here? 30 or 29, actually. You can see the market value basis earnings. So this takes into consideration any changes in market value. So your total dollar return, $2.9 million since inception.
What would the percentage be on the money?
If you look down below, you'll see the total return on the portfolio was 5.66.
Mr. Chairman,
Commissioner Nicolason.
while waiting for that, I had a question. Joan, you acknowledged that we're now into the fourth quarter. Going back to some of the indicators that are in this report for the end of Q2, can you just give us a summary of how things are looking, whether it's factors to consider for 6 to 9 months and whether those black dots have changed on page 19? You don't have to address anything too specifically, but just kind of bring us up to date,
Sure.
knowing that we'll get a final written report later.
You'll still see preliminary numbers for your Q3 report are still strong. Again, the allocation of commercial mortgage-backed securities has really kind of helped carry some value into your portfolio, even though, as I've mentioned, several times, that the spreads are at their multi-year lows right now. So we're not seeing a lot of opportunity to add value to your portfolio with corporate notes or really anything. I mean, we're just really kind of writing things right now, but we do have the ability, through the allocation of U.S. Treasuries that we have, that when spreads do start to widen out and, the market goes through cycles, so we will see that, then we will be able to take advantage of whatever opportunities present themselves in the market. But through the end of Q3, you'll still see a strong report when I get back to you here in another month or two.
This is Report to Wyoming.
On Thursday, October 2nd, the Wyoming State Board of Land Commissioners